In a landmark antitrust ruling, U.S. District Judge Amit Mehta concluded that Google's dominance as a search engine constitutes an illegal monopoly, but opted for a subdued remedy, influenced by the rapid advancements in artificial intelligence. The decision comes after a 5-year legal battle initiated by the U.S. Department of Justice, which sought to dismantle Google's stronghold by forcing the sale of its Chrome browser and halting its lucrative default search engine agreements. Instead, Meta's ruling requires Google to share portions of its vast search data with competitors, aiming to foster competition without imposing drastic structural changes. This light-handed approach has been met with criticism from antitrust experts and analysts, who view it as insufficient given the scale of Google's market power. The ruling has significant implications for the tech and financial markets. Alphabet Inc., Google's parent company, saw its stock surge by 9%, adding approximately $230 billion to its market capitalization, reflecting investor confidence in the company's continued dominance. Concurrently, Apple Inc., which benefits from Google's default search agreements, experienced a 3% rise in its stock. The decision underscores the increasing influence of AI in shaping competitive dynamics, with Google's response to AI-driven competitors like ChatGPT and Perplexity being pivotal to its future strategy. While the Justice Department maintains that the case will promote competition, the ruling's impact may hinge on whether Google's appeal delays the enforcement of data sharing provisions, which aim to balance competitive fairness and consumer privacy.
IndusInd Bank is facing significant turmoil following allegations made by its former chief financial officer, Gobind Jain, against the bank's board chairman, Sunil Mehta. Jain, who resigned in January, has accused Mehta of covering up long-standing accounting irregularities, which allegedly contributed to a dramatic 27% drop in the bank's stock price, the steepest since its listing. The allegations center on discrepancies in the bank's treasury operations, including inflated income from microfinance loans and misclassified assets, leading to a reported quarterly loss of approximately 2,000 crore rupees. Jain has called for the removal of Mehta and an independent probe, expressing concerns over a culture of fear and retaliation against those who supported his findings. IndusInd Bank, promoted by the Hinduja Group, has denied Jain's accusations, labeling them as baseless and motivated. The bank asserts that it has taken transparent measures by disclosing discrepancies to stock exchanges and engaging external agencies for investigations. The bank has also reported suspected frauds to regulatory bodies, such as the Serious Fraud Investigation Office, SFIO, and the Mumbai Economic Offences Wing, EOW. Despite these efforts, Jain's claims raise questions about the effectiveness of internal controls and governance at IndusInd Bank, with potential implications for investor confidence and regulatory scrutiny. The unfolding situation underscores the critical importance of robust corporate governance and transparency in maintaining market trust and stability.
President Donald Trump has launched a new cryptocurrency venture, World Liberty Financial, co-founded with his sons, introducing the token $WLFI. This launch has resulted in an on-paper gain of approximately $5 billion for the Trump family, although the token's price quickly fell from 32 cents to 22 cents after its debut. The initiative coincides with the signing of the Genius Act, the first significant standalone cryptocurrency legislation in the U.S., reflecting the Trump administration's shift towards a more crypto-friendly regulatory environment. This change is marked by the appointment of officials supportive of cryptocurrency, such as Paul Atkins, as head of the SEC, contrasting with the previous administration's stricter oversight. The development has sparked controversy and allegations of potential conflicts of interest, with critics like Senator Elizabeth Warren describing the situation as corruption. These concerns stem from the Trump family's financial interests in the cryptocurrency sector, which they are now in a position to influence through regulatory means. The administration, however, denies any conflict of interest. This intertwining of personal business with presidential influence raises questions about the implications for market regulation and political ethics, as well as the potential for increased investment in the U.S. crypto market under this new regulatory approach.
The Trump administration has petitioned the Supreme Court to uphold the president's authority to enact extensive tariffs under the International Emergency Economic Powers Act, IEEPA, following a federal appeals court ruling that deemed such actions beyond presidential power. The U.S. Court of Appeals for the Federal Circuit previously determined that the IEEPA does not allow for broad, indefinite tariffs, challenging the Trump administration's imposition of tariffs on countries such as China, Canada, and Mexico. The tariffs, which include a 25% levy on certain goods and reciprocal tariffs ranging from 10% to 34%, were justified by the administration as measures to address national emergencies, including the flow of fentanyl. The Supreme Court, with a 6-3 conservative majority, is now being asked to expedite the case, with both the Justice Department and the challengers agreeing to a swift timeline for review. The outcome of this case holds significant implications for U.S. trade policy and international relations. Should the Supreme Court side with the appeals court, it could limit the president's ability to unilaterally impose tariffs under emergency powers, potentially affecting ongoing diplomatic trade negotiations. The tariffs have generated substantial revenue but are criticized for dampening U.S. economic growth and contributing to inflation. Businesses like VOS Selections Inc. and Plastic Services and Products, along with 12 states, have challenged the tariffs, citing economic harm. The decision could set a precedent for the interpretation of presidential powers under the IEEPA and influence future administrations' trade strategies.
Gold prices surged by 1% on Wednesday, reaching a record high, driven by weak U.S. economic data that heightened expectations for a Federal Reserve interest rate cut. Spot gold hit $3,562.80 per ounce, after peaking at an all-time high of $3,565.57, while U.S. gold futures climbed to $3,627.40. The upward momentum in gold was fueled by a U.S. government report indicating a sharper-than-expected decline in job openings for July, reflecting a softening labor market. This development has reinforced market speculation that the Federal Reserve may opt for a rate cut to stimulate economic activity, enhancing the appeal of gold as a safe haven asset amid global uncertainty. The ripple effect of gold's rally was observed in other precious metals, with silver climbing 0.8% to $41.22, marking its highest level since September 2011. Platinum and palladium also saw significant gains, rising 2.1% and 1.6% to $1,432.12 and $1,152.68, respectively. The anticipation of a potential rate cut by the Federal Reserve typically leads to lower yields on interest-bearing assets, making non-yielding assets like gold and other precious metals more attractive to investors. The current scenario highlights the market's sensitivity to economic indicators and the broader implications of monetary policy shifts, as investors seek to hedge against economic and geopolitical uncertainties.
The upcoming Klarna IPO is poised to be one of the most significant public offerings of 2025, with the Swedish buy now pay later firm planning to raise approximately $1.2 billion. The company has set its share price between $35 and $37, which would value Klarna at around $14 billion, a notable decrease from its $45.6 billion valuation during a 2021 funding round. Klarna's listing on the New York Stock Exchange under the ticker symbol KLAR marks a pivotal moment as it transitions from a private to a public entity, allowing investors to purchase shares and the company to raise capital for growth. This IPO is part of a broader resurgence in the IPO market, which has seen a 58% increase in the number of offerings compared to the previous year, according to Renaissance Capital. The resurgence follows a recovery from earlier market uncertainties and is marked by successful IPOs from companies like Bullish and Figma. As the market heats up, particularly in high-growth sectors like fintech, Klarna's public debut is highly anticipated. However, potential investors should be cautious, as IPOs can be volatile and returns in the first year tend to be weak. The decision to invest in Klarna should align with an individual's risk tolerance and investment strategy.
Amazon has announced the termination of its Prime Invitee program, which previously allowed Prime members to share their free shipping benefits with individuals outside their household. This change, effective October 1, 2025, aligns with Amazon's strategy to encourage more individual subscriptions by offering a discounted annual rate of $14.99 for new members until December 31, 2025. The move is part of Amazon's broader efforts to streamline its Prime benefits under the Amazon Family Program, which permits the sharing of perks with only one other adult and several children within the same household. The decision reflects Amazon's ongoing investments in expanding its delivery network, particularly in less densely populated areas across the United States. By focusing on household-based sharing, Amazon aims to enhance its customer base while simultaneously driving subscription growth. This strategic shift could potentially impact Prime membership dynamics, influencing consumer behavior and possibly leading to increased revenue from new subscriptions. The company's focus on enhancing delivery services in smaller communities further underscores its commitment to maintaining a competitive edge in the e-commerce market.
The U.S. labor market is showing signs of cooling as job openings fell to 7.2 million in July, down from 7.4 million in June, according to the Labor Department's Job Openings and Labor Turnover Survey, JOLTS. This decline in job vacancies is below economists' expectations and highlights a slowdown in the labor market's recovery post-COVID-19. The number of Americans quitting their jobs remains steady at 3.2 million, indicating a cautious optimism among workers about finding better opportunities. Despite the drop, job openings remain at healthy levels but have significantly decreased from the record high of 12.1 million in March 2022. The cooling labor market can be attributed to the Federal Reserve's series of interest rate hikes aimed at combating inflation and uncertainties stemming from trade policies initiated by the Trump administration. These factors have contributed to a more cautious hiring approach among employers. The Labor Department is set to release August's unemployment and hiring data, with expectations of around 80,000 new jobs, a slight improvement from July's 73,000. However, the overall job creation rate has slowed to 85,000 per month in 2025, a significant decrease from the monthly averages of previous years. Despite the slowdown, layoffs remain below pre-pandemic levels, suggesting that while hiring is subdued, employers are not resorting to significant workforce reductions.
Ukraine's parliament has made a notable advancement in the realm of digital finance by passing the first reading of a bill aimed at regulating and taxing cryptocurrencies. This legislative proposal introduces an 18% income tax on profits from digital assets, aligning with the country's standard personal income tax rate, and an additional 5% defense tax. The latter often supports Ukraine's military and security needs, reflecting the nation's current geopolitical climate. This move signifies Ukraine's strategic effort to bring clarity to the crypto sector, which has seen significant adoption among its citizens, and to harness its economic potential while addressing regulatory challenges. The proposed tax framework is expected to have several implications for Ukraine's economy and its burgeoning crypto ecosystem. By integrating cryptocurrencies into the national tax system, Ukraine aims to generate substantial state revenue, particularly crucial during times of conflict and reconstruction. Furthermore, the legalization and regulation of digital assets are anticipated to enhance investor protection, curb illicit activities, and align Ukraine with global financial standards, potentially attracting foreign investment. However, the bill also poses challenges, such as ensuring compliance and maintaining competitive tax rates to prevent capital flight. As the bill progresses through further parliamentary readings and potential amendments, its final form will determine the full impact on individual investors and crypto businesses. The establishment of a clear legal framework could foster innovation and economic growth by encouraging more individuals and businesses to engage with cryptocurrencies, contributing to a more transparent and predictable environment for digital assets in Ukraine.
Vodafone Idea, V, is seeking a no-objection certificate, NOC, from lenders led by the State Bank of India, SBI, to monetize its fiber optic network, aiming to raise approximately 7,000 crore rupees for capital expenditure. This move comes as the telecom operator, burdened with significant debt, looks to secure funding from private credit or non-banking sources. Given the reluctance of banks to extend further credit, this total debt is around 2 lakh rupees crore, primarily from deferred spectrum payments and adjusted gross revenue (AGR) liabilities. The company is under pressure to fund its network investments, especially as it it aims to expand its 5G services across India by September 2025. The urgency for V to secure funding is heightened by the nearing end of a 4-year moratorium on AGR payments, with substantial installments due from March 2026. The company anticipates that a potential tariff hike by Reliance Jio could provide room to increase its own rates, offering some financial relief. Analysts suggest that the Indian government is unlikely to allow V to fail, as maintaining competition in the telecom market is crucial. Vice CEO Akshaya Mundra emphasized the need for resolution on AGR issues to facilitate bank funding, underscoring the ongoing efforts to keep the company's capex cycle active.